Hello, welcome back. So in today's video, I'll be talking about how to stop buying bad stocks. So in today's video, I'll be covering a few things. We'll be covering how to stop buying bad stocks, my entries for some of the stocks I have, as well as some questions that you guys have left me in the comment section below. So let's talk about how to stop buying bad stocks first. And before we start, this is a portion that I would like to play to you guys. It is a portion by a YouTuber called Defiant Gatekeeper.
As I mentioned, I was genuinely so sick and disgusted at all the videos on YouTube where they talk about Bitcoin to the moon. Look at me make $5,000 in 10 minutes. How to get rich quick. How to be a pro options trader. And why you need to quit your job right now and start a business. Just to get more views by telling people all sorts of convenient lies. I mean, no, Bitcoin is not going to the moon just because you're watching some random YouTube channel. No, you will not be a pro options trader just because you're watching a few irresponsible clips on YouTube. No, you'll not get rich quick just because you're watching YouTube.
So as what Defiant Gatekeeper said earlier as well, there's a lot of YouTubers as well as social media influencers that are quite irresponsible when it comes to stocks. All they do is they spend the entire day just posting about stocks going up, and there's a lot of hype online as well. So the first reason why people buy bad stocks is they buy into hype stocks. So you shouldn't be buying into hype stocks online on YouTube because the stock going up or trending on YouTube doesn't make it a good investment, and do not FOMO. Stocks going up doesn't make it a better investment unless the company is diluting shareholders and collecting money from the shares itself. So overall, when your stocks go up, it makes it a poorer investment. So social media as well is masked with a lot of survivorship bias. So investing is a zero-sum game. For someone to win, someone has to lose because someone buys a share off of another person. We only see the winners and not the losers in social media. And also, stocks going up leads to lower expected returns in the future as well. So when stocks go up, it doesn't necessarily make it a good investment, because when your stocks go up, it leads to less future expected returns for the shareholder. In fact, if you're a net buyer of stocks, you should want the stocks to go down, because in the long term, the markets will go up. But if you can catch opportunities when the stocks go down drastically, that is when you should be buying into the market. So this is what Warren Buffett said about stocks going down.
Just based on where we've come?
Well, anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of anything I buy. But you know, stocks are going to go down. You could probably look it up as to what percent of the days, since I was born, they've gone down, and maybe it'd be 30% or something like that. And you can't predict what stocks will do, but in the short run. But you can predict that American business will do well over time. And just take the 20th century. Stocks went from 66, the Dow average, 66 to 11,497, and you were getting 3 times as much in dividends as the whole average was selling for at the start. And you had 2 world wars, and you had a Great Depression, flu epidemics, all kinds of things. American business will do fine over time, and if you own a piece of it, and if you don't beat yourself, the only person that can cause you to get a bad result in stocks is yourself.
Yeah.
So another reason why people buy into bad stocks is because they don't focus on the business quality. So you should focus on the business quality rather than the cheapness of a stock. A quality stock can defend its moat and continue earning predictable cash flows, whereas a poor company won't be able to unless you are buying the stock and praying for liquidation of assets. So buying cheap stocks might not be a good idea as well, because a cheap valuation doesn't mean the stock is good, neither does a high valuation mean that a stock is great. Companies in your airline industry have been terrible investments despite trading at single-digit PEs. Same for a company like Ford. So this is Ford's net income over the past 10 years. As you can see, the company has been doing terribly. The net income is not predictable at all. And for this company, the weighted average cost of capital is actually greater than the returns on invested capital. So this company has a high reinvestment rate as well. I believe their reinvestment rate is around 100%. So this is shareholder destroying. It will be much better off if they just return all the cash to shareholders. And for companies like this that look cheap on the surface, they are actually terrible investments. So another reason why people buy into bad stocks is simply because they lack the patience. So a high quality business can become a bad investment if done in bubble territory. So always value a company and weight against opportunity cost, against the market discount rate or other compounding machines as well. Paying a slight premium for quality is fine, but going overboard with it will lead to lowered market returns over time. So for example, this is MSCI. It's an amazing business. And for MSCI, over the past 3 to 4 years or so, the stock is actually down around 15% from the highs in 2021. So During that time, MSCI's fundamentals actually grew, so there was nothing structurally wrong with the business. But the problem with the business at that time in 2021 was the stock was trading at too high a valuation. So I believe it was trading at around 65 times earnings. And during these 4 years, what happened was the fundamentals grew and the valuation just dropped. So if you bought at the peak in 2021, it would have turned out to be a terrible investment, although the company is great. So don't go overboard when it comes to overpaying for quality companies. A high quality company might not be the best investment at that time as well. So another reason why people buy into bad stocks is they buy stocks because they fall. So if a stock is down 80%, some people will say it must be cheap, but no. Sometimes it's down 80% because it's a terrible company. So Chex, for example, is a company that was down around 80% or so at one point, and currently is down even lower than that. I believe it's down around 95% since the highs already. And for Check, the problem in the business was it was being disrupted by ChatGPT. So for Check, it does something in the education business. What they do is they sell notes and materials online, and those materials could have been easily obtained on ChatGPT itself. Same for a company like Peloton, which rose up in the 2000s or so. So don't buy a stock simply because it has fallen 80%. A stock has no memory of its stock price a day ago, so don't ever fall into the trap of price anchoring. So the last reason why people buy into bad stocks is simply because they're speculating instead of investing. So they buy in and out of stocks too often. They buy stocks because they think they're going up rather than the business fundamentals going up. So these are trading mindsets, not investing. If you want to invest like Warren Buffett and be a value investor, then you shouldn't be adopting any of these mindsets, because in the short term, the market is a voting machine, but in the long term, the market is a weighing machine. So what this means in the long term is that the stock price of the companies in the long term will follow its fundamentals itself. And over the long term, all the speculative companies will be swept away and only the strongest companies will remain. So when buying your stocks, pick the ones that are the highest quality and the ones that are trading at the most reasonable valuation so that the stock price can compound and compound over time as well. Next portion, I'll be talking about some of the stocks and some of the entries that I have for them. So the first stock is for MSCI. So this is my discounted cash flow analysis of MSCI. So MSCI has been able to grow revenue at between 11 to 12% over the past few years, and I expect them to continually do so. So for MSCI, assuming a 13% free cash flow growth rate from year 1 to year 5, and assuming an 11% growth rate from year 5 to year 10, with a 3% terminal growth rate as well, this company's fair value is at around $560. So I added MSCI previously at fair value at around $540. I want this stock to fall a bit more so that I can add it at a margin of safety of around 10%. So my next add for MSCI will probably be at around $500 a share. Next one is for United Health. So this commenter over here actually said, it would be great if you can dedicate a portion on technical analysis and potential entry points. So for United Health, over the past 5 years, the PE ratio is at around a 25 times average, and currently now is trading at a 12 times earnings. So even over the past 10 years itself, United Health's average PE ratio is at around a 22 times. So clearly this stock is undervalued in terms of your PE ratio metric. And for United Health, because the free cash flow is a bit more erratic, I've chosen to use the EPS calculation. And assuming a $20 EPS for this company, which is a 20% drop from its current EPS, and assuming a 10% growth for the next 5 years, assuming an 18 times PE for this company will give you around a 15% CAGR over the next 5 years. So clearly, United Health is a company that is quite cheap, it's quite undervalued, so I wouldn't care too much about the technical analysis and the possible entry points for this company. I think over the long term, if you buy it at any of the prices today, if the company still stays fundamentally strong, then you will likely beat the markets over time. Bear in mind that this company is a company that has substantial risk, so be careful when adding into this company. Last portion, I'll be talking about some questions that you guys have left me in the comment section below. So the first one, it says, what do you think about Grab? I'm asking this because you are based in Southeast Asia region. So for Grab, this is their net income. They just turned net income positive this year. And for Grab, I think the problem with the business itself is it is too early in the stages of becoming mature. So it is a company that just turned net income positive. And normally one of the criteria that I have for my stocks is a history of predictable earnings as well. So for Grab, they don't have that yet, and they are a bit too immature for my liking. And for Grab, I think it faces a lot of competition as well in the Southeast Asia region. So for example, in Singapore, you have Tada, you have other ride-hailing platforms as well. And even a local taxi network has their own ride-hailing platform as well. So for Grab, they face a lot of competition in the ride-hailing segment. And even for a company like Uber, even for a company as big as Uber, I don't think Uber has a very substantial moat. For Grab, I think the only way for them to differentiate themselves is to basically turn the company into a credit card company, similar to what a lot of the US fintech companies are doing. So for Grab, I don't think it's an investment that I would likely make, simply because the company is too immature and because I don't think the company has any sort of pricing power. So I would likely stay out of this one for now. Next comment, it says, what do you think about Brookfield Corporation? So if you're to look into Brookfield Corporation's balance sheet itself, The total assets is around 490 million and the total equity is at around 41 million. So for Brookfield, the problem with the business is simply too leveraged. So equity is similar to net worth, whereas your assets is whatever you own. So think of it this way, for every $10 of property or assets that Brookfield owns, $9 of it is not owned by them and only $1 of it is actually owned by the company itself. So for this company, the assets to equity ratio is simply too leveraged, and so I don't think I'll be comfortable adding into this one. I don't understand the business as well. The company is extremely complicated. It has a lot of different segments. And with high leverage like this as well, it is prone to interest rate changes. So for Brookfield Corporation, it operates under your asset manager portion of your business. And typically these businesses are not very predictable. So I would stay out of this one as well. I hope you guys have found this one useful and invest safe.